Good day, everyone. I am Justin L. Columba, and today I am going to discuss the asset liability management. Imagine a bank as a big store. They have things they own, which is assets, like loans they give out and money they invest. They also have things they own, which is liabilities, like deposits from customers. Asset liability management, or ALM, is like the bank's manager who makes sure everything is balanced and working well. They try to make the most money by lending money at higher rates than they pay on deposits, protect against changes in interest rates. If interest rates go up, it can be bad for the bank. ALM helps them stay safe from this. This manager, ALM, works with the team ALCO and focuses on the short-term goals of the bank, like what to do with money in the next few months. It's a maintain sufficient capital as a safety net and improve the bank's overall value. This is usually a short-term strategy, focusing on near-term financial goals, and is handled by a special team within the bank. It's a crucial part of the bank's overall planning and risk management. An overview of market rates of interest. The interest rate on 10-year U.S. government treasury bonds peaked in 1981 at 13.1% and declined to 10.62% in 1985. The decline in market rates of interest continued through the end of 2009. Similarly, 3-month Treasury bills peaked at 14.4% in 1981 and declined to 0.15% in 2009. The major point to take away from this figure is that the long-term decline in market rates of interest played a key role in the willingness and ability of borrowers to acquire funds and refinance existing loans at lower rates. Similarly, because banks typically borrow short-term funds and make longer-term loans, the fluctuating spread between the short-term treasury bills rates and the long-term 10-year bond rate gives some idea of how bank NIMs may have changed during the period shown. Both market rates of interest and NIMs change over time, and the changes are not always favorable to banks or borrowers. In simpler terms, the provided graph analyzes U.S. market interest rate trends from 1985 to 2010, illustrated by a graph showing the decline of both 10-year and 3-month treasury rates from their 1981 peaks. This decline significantly impacted borrowers, enabling easier access to funds and loan refinancing at lower rates. The fluctuating spread between these short-term and long-term rates, however, reveals how banks' net interest margins likely changed over time, demonstrating that these market shifts don't always benefit banks or borrowers equally. The analysis ultimately connects historical interest rate fluctuations to their consequences for both banking profitability and borrowing costs. Let's proceed to income risk and liquidity risk. Banks make money by lending out deposits at higher interest rates than they pay on those deposits. Income risk arises when interest rates on loans and deposits don't change simultaneously, creating a dollar gap, which is a dollar gap is a mismatch between rate-sensitive assets or loans and liabilities or deposits. This gap can reduce profits if, for instance, loan rates rise faster than deposit rates. Assets and liabilities are classified as rate sensitive, or interest rates adjust frequently, or non-rate sensitive or fixed rate for longer periods. On the other hand, liquidity risk is the danger of not having enough readily available cash to meet obligations. This risk threatens both earnings and the bank's capital if it cannot quickly convert assets to cash or borrow funds when needed. Essentially, income risk is about profit, while liquidity risk is about having enough cash on hand. This figure presenting UBPR liquidity ratios for Ally Bank as March 31, 2010. The table lists various ratios expressed as percentages of total assets categorized into percent of total assets and liquidity ratios. Each ratio has three columns showing the values for the bank. Page 1 or presumably a peer group comparison, and the percentage difference. The ratios really relate to short-term investments, marketable equity securities, core deposits, short-term non-core funding, and several measures of liquidity such as net non-core fund dependence, brokered deposits, and the ratio of net loans and leases to deposits. Let's proceed to fixed versus variable rate loans. The terms fixed rate loans and variable rate loans confuse the issue of rate sensitivity. The maturity and frequency of repricing assets determines rate sensitivity. Hence, fixed rate loans. Fixed rate loans is the interest rate stays the same for the entire loan period. You know exactly how much you'll pay each month. Whereas variable rate loans is the interest rate can change over time, usually based on benchmark rate, like the prime rate. Your monthly payment might go up or down. For instance, fixed rate overnight loans are rate sensitive asset because they are repriced every day. By contrast, a variable rate 30-year mortgage that resets the interest rates once every 3 years is not a rate sensitive asset. To make it more understandable, let's proceed to repurchase agreements. Repurchase agreements or repos are short-term contracts to sell and repurchase financial assets such as treasury securities at a future date. The maturity of repo contracts ranges from overnight to 2 years. When the contract expires, the seller repurchases the securities at the price at which they were sold and pays interest for the use of the fund. From the point of view of the institution buying the security, it is a reverse repo. Here's the example. Imagine you need some quick cash. You could sell some of your valuable assets like government bonds and buy them back later. That's basically what a repo is. It's a short-term agreement to sell something and promise to buy it back at a slightly higher price. It's a way for banks to borrow money quickly. Let's go back to rate-sensitive and non-rate sensitive assets and liabilities that are shown in Table 4.2. Table 4.2 categorizes financial assets and liabilities based on how sensitive their interest rates are to changes in market conditions. It's broken down into two sections, non-rate sensitive and rate sensitive. For non-rate sensitive, these assets and liabilities have interest rates that don't change frequently or are fixed for a longer period. This means their value is less affected by short-term interest rate fluctuations. Examples include long-term fixed-rate loans, long-term bonds, fixed-rate mortgages, long-term time deposits, fixed-rate notes and debentures, and equity capital. For rate-sensitive, these assets and liabilities have interest rates that adjust more frequently, making their value more susceptible to changes in market interest rates. Examples include floating rate loans, federal funds sold, short-term securities, short-term time deposits, federal funds purchased, and other short-term variable rate sources of funds. In essence, the table helps illustrate how a bank's assets and liabilities can be categorized based on their exposure to interest rate risk. Understanding this distinction is crucial for managing a bank's overall interest rate risk profile. Let's proceed to Basel III liquidity standards. The Basel Committee on Banking Supervision's revised bank capital rules, called Basel III, include minimum liquidity standards called the Liquidity Coverage Ratio, LCR, that will be implemented during the 2013 to 2019 period. The LCR requires banks to have high-quality liquid assets that should be equal to or greater than their net cash outflows over 30 days. Net cash outflows are the expected cash inflows less cash outflows adjusted for stress conditions. This is the formula. LCR equals stock of high-quality liquid assets over net cash outflow over 30 days is greater than equal 100%. Basel III also includes a net stable funding ratio, or NSFR, that requires banks' available stable funding should at least equal its required stable funding. Here is the formula or equation. NSFR equals available amount of stable funding over required amount of stable funding is greater than equal to 100%. Let's proceed to the effects of interest rate risk on income and market value. The dollar gap and net interest income. In banking jargon, the dollar gap is the difference between rate-sensitive assets or RSA and rate-sensitive liabilities or RSL, expressed in dollars. Here is the equation. Gap equal RSA minus RSL. The dollar gap is widely used as a measure of interest rate sensitivity. When RSA is greater than RSL, a bank is said to be positively gapped. When RSA is less than RSL, a bank is negatively gapped. The dollar amount of the gap times the change in interest rates gives the change in net interest income. The net interest income, on the other hand, or NII, is interest income less interest expense. Here is the equation. Change in net interest income equals gap times the change in interest rates. For example, if a bank had a negative gap of $100 million and interest rates increased by 50 basis points plus 0.005, NII will decline by $500,000. Notice that the dollar amount of the negative gap is preceded by a minus sign. This symbol means change. For example, change in NII or net interest income equals gap times change in interest rates. Here is the table 4.3, gap changes in interest rates and NII. The effects of changing interest rates and NII are summarized in this figure. For banks with a positive gap, NII will rise or fall as interest rates increase or decrease. For banks with a negative gap, NII will increase or decrease inversely with changes in interest rates. Stated otherwise, if interest rates increase, NII will decrease. In contrast, interest rate changes do not affect the NII of bank with a zero gap. Let's proceed to the effects on market value. Here is the figure 4.3, the effects of interest rates and bank values. If we assume that the value of a bank is positively related to its net interest income, we can illustrate graphically the effects of changes in interest rates and bank market values. The top panel of this figure shows the effects on interest rate changes in a bank that is positively gapped, or RSA is greater than RSL. If interest rates increase, the returns in assets will increase more than the cost of the liabilities, thereby increasing the net interest income. Consequently, the value of the bank will increase. If interest rate decline, the cost of the liabilities will exceed the returns on the rate-sensitive assets, and net interest income will shrink. The market value of the bank can decline, and it can become insolvent. On the other hand, the lower panel of figure 4.3 illustrates the effects of changes in interest rates in a bank that is negatively gapped, or RSA is less than RSL. If interest rates increase, the market value of negatively gapped bank will decline because its cost will exceed its returns, resulting in lower net interest income. However, if interest rates decline, the cost will decline more than the returns, thereby increasing the bank's net interest income and market value. Now let's proceed to managing interest rate spreads. Interest rate risk affects the net interest income and the value of banks. For banks that are positively gapped, an increase in interest rates results in higher incomes and values. For banks that are negatively gapped, the reverse is true. This suggests that if banks gap correctly, they can increase incomes and values. To make it more understandable, here is an explanation of the figure 4.4. Figure 4.4 illustrates how banks can manage interest rate risk and optimize their net interest income by adjusting their asset and liability strategies based on the phase of the business cycle. recovery, prosperity, recession, and depression. The figure shows that short-term interest rates tend to follow a cyclical pattern, peaking during prosperity and bottoming out during depression. The strategies are categorized into actions for assets and liabilities. For assets, recovery, increase rate sensitive assets like assets whose return change with interest rate changes, and avoid fixed rate loans. This strategy benefit from the expected rise in interest rates during recovery. For prosperity, encourage fixed rate loans to lock in high yields. Since interest rates are high during prosperity, locking in fixed rate loans ensures high returns. For recession, encourage fixed rate loans. The strategy remains consistent with the previous phase, continuing to benefit from high yields. Lastly, depression. Sell fixed rate loans and investments to supplement income and increase rate sensitive assets in anticipation of higher rates during the subsequent recovery. This is a defensive strategy to maintain income and prepare for the next upward cycle. Now for the liabilities. Recovery. Encourage fixed cost sources of funds, like funding whose cost doesn't change with interest rate changes. This strategy helps maintain profitability as interest rates rise. Prosperity. Encourage short-term sources of funds and avoid high-cost fixed-rate sources. Short-term funding allows for flexibility as interest rates may fluctuate. Avoiding high-cost fixed-rate sources preserves profitability. Recession. Obtain short-term sources of funds. This maintains flexibility in a volatile environment. Lastly, the depression. Borrow long-term at fixed rates. This strategy secures low-cost funding for the long term. This figure 4.4% spread management strategies for banks across different business cycle phases. The strategies involve adjusting asset and liability portfolios to optimize net interest income based on anticipated interest rate movements. The strategies are tailored to each phase: recovery, prosperity, recession, and depression, to maximize returns and minimize risk. The key is to align asset and liability strategies with the predicted direction of interest rates. Let's proceed to the duration gap and economic value of equity. While the dollar gap analysis focuses on a bank's short-term net interest income, the duration gap takes a longer view and focuses on the economic value of equity. Duration is defined as the weighted average time to maturity to receive all cash flows from a financial instrument. Time is measured in terms of years and months. It is a widely used measure of interest rate sensitivity. The concept of duration originated in 1938 when Frederick R. Macaulay wanted an alternative to the term to maturity for measuring a bond's life. Duration is the weighted average time to maturity of the present value of all cash flows received from bonds, stocks, or financial assets. For example, the duration of bonds that can be approximated by the following equation, where D duration in years, C annual income from bonds, and number of years to maturity, R rate of return yield to maturity, P0 current market price of the bond, while PVF Rn present value of an annuity interest factor as a certain rate R for n years. Now take a look at table 4.4, bond durations for selected interest rates and maturities. As shown at this table, the duration of the 20-year zero coupon bond is 20 years, while the duration of a 20-year bond that pays 8% interest semi-annually is 10.29 years. The logic behind this is that all of the cash flows from the zero coupon bond, $1,000, are received at maturity, while interest payments, $1,600 over the life of the bond account for 62% of the total cash flows. $2,600 from the 8% bond are paid out. Except for zero coupon bonds, duration is always less than the term to maturity. For bonds with the same maturity, those with high coupon yields have shorter durations than those with lower coupon yields. Now let's proceed to duration gap management strategies. Take a look at Table 4.5, Duration Gap, Change in Interest Rates, and Change in Equity. This table summarizes how the duration gap and changes in market rates of interest have an impact on a bank's equity. If the duration gap is positive and interest rate increase, the value of the equity will decline. Conversely, if the duration gap is positive and interest rates decrease, the value of the equity will increase. When the duration gap is negative, an increase in interest rates result in an increase in equity, while a decrease in rates results in a decrease in equity. Immunization, in the context of ALM, is a risk management strategy aimed at protecting a bank's equity value from fluctuations in market interest rates. It's achieved by aligning the duration of a bank's assets and liabilities. When durations are equal, changes in interest rates exert approximately equal and offsetting effects on the market values of assets and liabilities, thereby stabilizing the net worth. Limitations of duration. While duration is a crucial tool for implementing immunization, several factors limit its effectiveness. First is the embedded options. The presence of embedded options within financial instruments introduces uncertainty into duration calculations. The exercise of these options by customers can significantly alter the actual duration of assets and liabilities, potentially undermining the immunization strategy. Prepayment risk and call risk. The prepayment of loans or the calling of bonds before their stated maturity dates directly impacts duration. These events shorten the effective durations of assets, creating a mismatch with the durations of liabilities and exposing the bank to interest rate risk. Non-parallel yield curve shifts. Traditional duration models assume parallel shifts in the yield curve. However, real-world yield curve shifts are often non-parallel, with different maturities experiencing varying changes in interest rates. This non-parallel movement makes it difficult to accurately predict the impact of interest rate changes in the market values of assets and liabilities, rendering duration-based immunization less reliable. Duration drift. Duration is not static. It changes continuously as time passes and instruments approach maturity. This necessitates frequent recalculations of durations to maintain the effectiveness of the immunization strategy. The ongoing recalculations process itself introduces operational challenges and potential errors. Lastly is the problem loans. The accurate estimations of duration for problem loans, such as non-performing or severely delinquent loans, presents as a significant challenge. These loans often lack predictable cash flows, making it difficult to determine their durations and incorporate them reliably into the immunization framework. In conclusion, effective asset liability management or ALM is crucial for financial health and stability of any financial institution. A well-designed ALM strategy aims to optimize the balance between profitability and risk, ensuring the institution can meet its obligations while maximizing returns. This involves careful considerations of interest rate risk, liquidity risk, and credit risk, utilizing various tools and techniques such as durations analysis, gap analysis, and stress testing. Successful ALM requires a proactive and dynamic approach, adapting to changing market conditions and regulatory requirements. Ultimately, a robust ALM framework protects the institution's solvency, enhances its competitive position, and contributes to long-term sustainable growth.